Most people dread tax season. They wait until the last possible moment, pile up receipts, rush through forms, and hope they don't owe too much. But here's the reality. That approach is exactly why so many people overpay and miss out on opportunities. Taxes aren't just about compliance, they're about strategy. 8. And 2025 is bringing changes that will catch a lot of people off guard. Some will pay more because they didn't prepare, while others will legally save thousands simply because they took the time to understand and adjust. The difference isn't luck, it's knowledge and action. This year, you've got a choice: be part of the group that complains about how unfair the system is, or be part of the group that learns the rules and uses them to win. In this talk, we're going to cover exactly what you need to do now to stay ahead. We'll break down the new rules, show you how to maximize deductions and credits, explore how to adjust your income and investments, and most importantly, build a year-round strategy so you're always in control. Because taxes don't just affect your refund this year, they shape your long-term wealth. And if you get smart now, 2025 could be the year you stop just working for money and start making the system work for you. Understand the new 2025 tax rules if you want to get ahead in 2025. The first thing you absolutely must do is understand the new tax rules. Think of it like playing a game. If the rules change and you don't bother to learn them, you're going to lose every time. That's exactly how most people treat taxes. They file their return, cross their fingers, and hope for the best. But hoping isn't a strategy. Knowing the rules is. The new bill for 2025 has shaken things up. Tax brackets have shifted, deductions have been updated, and new credits have been introduced. For the average person, this all sounds complicated, so they switch off. But here's the harsh truth: ignorance is expensive. 8. If you don't understand how these new rules work, you'll pay more than you need to. And the money you lose doesn't just disappear. It goes straight into the system, while the people who did their homework keep more in their pockets. So, where do you start? Begin with tax brackets. Every year, the government adjusts them, sometimes slightly, sometimes significantly. This means the amount of income taxed at certain percentages changes. If your income is close to one of those thresholds, a small difference could push you into a higher bracket and cost you thousands. By understanding where you stand, 8, you can make adjustments, like contributing more to retirement accounts to stay in a lower bracket. That's a simple move that most people miss, but it can have a big impact. Next, look at standard deductions versus itemized deductions. The standard deduction is a flat amount that lowers your taxable income. And in 2025, it's been raised again to keep up with inflation. That's good news for many people. But here's the thing: if you have significant expenses like mortgage interest, medical costs, or charitable donations, itemizing could save you even more. Too many people blindly take the standard deduction without running the numbers. The winners compare both options and choose whichever saves them the most. Now, let's talk about credits. A deduction reduces the income you're taxed on, but a credit reduces your tax bill dollar for dollar. That's why credits are pure gold. In 2025, there are updates to family credits, education benefits, and even incentives for making energy-efficient upgrades to your home. But if you don't know about them, you can't claim them. And here's the crazy part: billions of dollars in tax credits go unclaimed every year simply because people don't take the time to check. 8, don't be one of them. Another important change is how business and side hustle income is treated. With so many people starting small businesses or freelancing, the government has adjusted rules around deductions for business expenses. This means if you're running a side hustle, even something small, you could qualify for deductions on things like equipment, internet, or part of your home office. The 48, if you understand these rules, you can legally reduce your taxable income and keep more of what you earn. If you don't, you're just giving the government free money. Let's not forget about investments. Capital gains, dividends, and retirement contributions are all affected by the new bill. Long-term capital gains are still taxed more favorably than short-term, but the thresholds for who qualifies have changed. That means if you plan your investments right, you can benefit from lower rates. If you don't, you could pay more than necessary. Understanding these changes gives you the power to time your investments strategically. Here's a real-life example. Imagine two people both earn $70,000 a year. Person A ignores the new rules, files the same way they always have, and ends up paying thousands more in taxes. Person B takes the time to learn the changes. They adjust their retirement contributions, claim new credits, and make small tweaks to their deductions. Same income, same year, but person B keeps thousands more. That's the power of understanding the rules. The bottom line is this: 8. The new 2025 tax rules aren't something to fear, they're an opportunity, but only if you take the time to learn them. Don't wait until April when it's too late. Start now. Read summaries of the changes, talk to a professional if you need to, or even just use online resources to compare your situation. The information is out there, but it's useless if you don't act on it. Knowledge is your edge. Most people won't bother learning the details. They'll keep playing the game blindly and losing money year after year, but not you. By understanding the 2020-25 tax rules, 2, you put yourself in the winning category, the group that uses the system to keep more of what they've earned. And that's the first step to turning tax season from something you dread into something you actually win. Maximize deductions and credits. If there's one area of taxes that most people completely overlook, it's deductions and credits. And that's a big mistake because these are the tools that can shrink your tax bill more than anything else. In simple terms, deductions lower the amount of income you're taxed on, while credits directly cut down the tax you owe. If you don't maximize these, you're leaving free money on the table, and once it's gone, it's gone. Here's the problem: most people take the easy route. They grab the standard deduction and move on. Now, there's nothing wrong with the standard deduction. It's designed to make filing simpler, and in 2025, it's been increased again, which means most people will save a bit without lifting a finger. But here's where you separate yourself from the average taxpayer. You don't just accept the standard deduction blindly. You run the numbers to see if itemizing could save you more. Itemized deductions cover things like mortgage interest, property taxes, large medical expenses, and charitable donations. If you're a homeowner, especially with a mortgage, or someone who gives generously to charity, itemizing could slash thousands off your taxable income. Imagine paying tax on a $55,000 instead of $60,000. That's money staying in your pocket simply because you checked. Now, let's talk about credits. Credits are where the real game-changing savings happen. Unlike deductions, which only lower the income that's taxed, credits reduce your tax bill dollar for dollar. For example, if you owe $4,000 taxes but qualify for a $1,000 credit, your bill drops to $3,000. That's powerful. In 2025, several credits are either expanded or adjusted. Family credits are one of the biggest. If you have kids, you might qualify for child tax credits that take a massive bite out of your bill. Education credits are also huge for students or parents helping pay for college. These can offset tuition costs and ease the financial burden of higher education. But here's the one that many people overlook: energy-related credits. With governments pushing for greener choices, the new bill rewards homeowners who invest in things like solar panels, energy-efficient windows, or even electric vehicles. These aren't just lifestyle upgrades, they can knock thousands off your tax bill. Yet most people never even think to check. Another goldmine lies in health-related deductions. If you've had high medical expenses, say treatments, surgeries, or even insurance premiums, you might be eligible to deduct amounts above a certain percentage of your income. Many people never claim this simply because they don't track their expenses properly. That's why keeping detailed records is so important. And let's not forget about education savings accounts or retirement accounts. Contributions to accounts like 401(k)s, IRAs, or HSAs, health savings accounts, often come with deductions that lower your taxable income. Think about it. You're saving for your future while cutting your current tax bill at the same time. That's a double win. If the new bill raised contribution limits and you don't take advantage, you're handing over money you could have kept. Let's make this real with an example. Suppose two people both earn 70,000. Person A takes the standard deduction, ignores credits, and pays whatever the tax software tells them. Person B digs deeper. They itemize their deductions, claim a child tax credit, and invest in a tax advantage retirement account. At the end of the year, person B might legally save $5,000 or more compared to person A. Same income, different outcome, all because one person knew how to maximize deductions and credits. The key here is awareness and preparation. 48. You can't claim what you don't track. If you're not recording your donations, if you're not keeping receipts for medical expenses. 8. If you're not logging home improvements, you're going to forget, and the IRS isn't going to remind you. That's why smart taxpayers treat this like a year-round game. 8. They keep a simple folder or app to record expenses as they happen. By tax season, they're not scrambling, they're ready. Now, here's the mindset shift. Stop thinking of deductions and credits as tricks or loopholes. They're not. 8. They're incentives built into the system to encourage certain behaviors like owning a home, saving for retirement, supporting education, or going green. 8. The government wants you to take advantage of them. The only people who lose are the ones who don't bother. Maximizing deductions and credits isn't about gaming the system. It's about playing the system the way it was designed. And if you don't, you're not just overpaying, you're holding yourself back financially. That money could have been used to pay down debt, invest in your future, or even just give you more breathing room in your budget. So here's the bottom line. When it comes to your 2025 tax return, don't just file, be intentional. Compare standard vs itemized deductions. Hunt down every credit you qualify for. Keep records year-round so you don't forget. Because every dollar you keep is a dollar that works for you instead of disappearing into the system. Adjust your income and investment strategy. When it comes to taxes, one of the most important lessons to understand is this: not all income is taxed the same way. The type of income you earn and how you structure your investments can have a huge impact on how much you keep versus how much disappears into the government's pocket. The new 2025 tax rules have shifted the landscape again, and if you don't rethink how you earn and invest, you could end up paying thousands more than you need to. Most people assume all money is equal. They believe if you make 70,000 from your job, it's the same as making 70,000 from investments or a side hustle. But that couldn't be further from the truth. Regular wages are taxed at ordinary income rates, which tend to be the highest. Investments, on the other hand, especially those held long-term, are often taxed at much lower rates. And business income, that opens the door to deductions and strategies that employees can't access. Understanding these differences and adjusting your approach can make all the difference. Let's start with earned income, your paycheck. In 2025, the tax brackets have shifted again. If you're close to the edge of a higher bracket, a pay raise, bonus, or side income could push you up, meaning more of your money is taxed at a higher rate. But here's the smart move. Instead of taking that hit, you can redirect income into tax-advantaged accounts. For example, increasing your contributions to a 401(k) or IRA lowers your taxable income today. You're essentially choosing to pay yourself for the future rather than handing the money over in taxes now. Next, let's talk about investment income. The tax code rewards long-term thinking. If you sell an investment you've held for over a year, you pay long-term capital gains tax, which is usually much lower than ordinary income rates. But if you sell too quickly, you get slapped with short term rates, the same as your paycheck. So, a smart move in 2025 is to be strategic about when you sell investments. Don't cash out just because you feel like it. Think about the tax impact. Waiting a few more months could save you thousands. And don't forget about dividends. Qualified dividends are taxed at the lower capital gains rate, while non-qualified ones are taxed like ordinary income. That's why choosing the right investments matters. If the new tax bill adjusted dividend thresholds, it's even more important to pay attention. Choosing investments that produce favorable tax treatment means you're working smarter, not harder. Now let's move to business and side hustle income. This is where the opportunities really expand. Unlike a paycheck, business income allows you to deduct legitimate expenses, things like equipment, travel, a portion of your home office, and even internet costs. That means you're only taxed on your profit, not your total income. If the new 2025 bill added or expanded deductions for small businesses, and you're not taking advantage, you're throwing away money. Even a small side hustle can open the door to powerful tax strategies. Another key area is retirement accounts and tax-advantaged savings. In 2025, contribution limits for accounts like 401(k), IRAs, JSAs, health savings accounts, and 529 education savings plans may have increased. That means you can shelter even more of your income from taxes while preparing for the future. An HSA, for example, is a triple win. Money goes in tax-free, grows tax-free, and can be withdrawn tax-free for medical expenses. If you're not maximizing these accounts, you're leaving easy tax savings on the table. Let's make this real with an example. Imagine two people both earn 80,000 in 2025. Person A works a regular job, spends everything they make and doesn't invest. Person B works the same job but contributes a 10,000 to a 401(k), invests in long-term stocks, and runs a small side hustle that brings in 5,000 but deducts 3,000 in expenses. On paper, both earned around 80,000, but person B's taxable income is far lower, and much of their money is taxed at favorable rates. By the end of the year, person B legally pays thousands less in taxes and keeps that money working for them. The big takeaway here is these taxes aren't just about how much you make, they're about how you make it. If all your income comes from a paycheck, you'll always be stuck with the highest tax burden. But if you diversify into investments, side hustles, and tax-advantaged accounts, you start controlling the game. The 2025 tax rules aren't designed to punish you, they're designed to encourage certain behaviors. The system rewards people who invest, save for retirement, and build businesses. If you play by those rules, you'll pay less and build more wealth. If you ignore them, you'll always be handing over more than you should. So ask yourself, how is your income structured right now? Are you relying only on a paycheck, or are you setting yourself up with smarter streams of income? A. Are you timing your investment strategically? Are you maxing out accounts that cut your tax bill? The people who win this year won't be the ones who worked harder, they'll be the ones who work smarter with the rules in front of them. Plan ahead instead of reacting at the deadline. When it comes to taxes, most people treat it like a fire alarm. They ignore it all year long, and then when April comes around, they panic, scramble for receipts, and hope for the best. But let me tell you the hard truth, tax season is not the time to plan, it's the time to report. By the time you're sitting down with your tax forms, the year is over. The opportunities to reduce your tax bill, shift income, or maximize deductions have already passed. That's why the winners, the people who keep more of their money, don't wait until the deadline. They plan all year round. They think ahead, make adjustments early, and position themselves so that by the time tax season arrives, they're prepared. And in 2025, with new tax rules in play, this proactive mindset is more important than ever. Think about it this way, taxes are like a game with a scoreboard. The government sets the rules, the 48, and you decide how you want to play. If you only look at the scoreboard at the end of the game, you've already lost. But if you pay attention as the game goes on, 8, you can adjust your strategy and come out ahead. So how do you plan ahead effectively? The first step is keeping good records. Too many people leave money on the table because they didn't track expenses properly. If you have a side hustle, keep every receipt. If you're investing, track when you bought and sold assets. If you're contributing to retirement or health savings accounts, monitor those throughout the year. It doesn't have to be complicated. Use a simple spreadsheet, an app, or even a folder for your receipts. The point is, when you plan ahead, you're not left scrambling later. The next step is scheduling tax check-ins during the year instead of waiting until March or April. Set aside time every few months to review your income, expenses, and potential deductions. Did your income push you into a higher bracket? Adjust your retirement contributions now. Did you have a big investment gain? Maybe you can offset it with a loss elsewhere before the year ends. Waiting until the deadline means you've missed your chance. Acting early gives you options. Another powerful strategy is projecting your tax liability. Many people wait until they file to find out whether they owe or get a refund, but you can actually run the numbers throughout the year. There are calculators and even simple worksheets that estimate your tax bill based on your income and deductions so far. Doing this ahead of time lets you adjust. If you're headed for a big bill, you can start saving for it. Or better yet, take action to reduce it while there's still time. Now let's talk about major life changes. Did you get married, have a child, buy a house, or start a business in 2025? Every one of those events has tax consequences. 8, if you wait until the deadline to figure it out, you'll miss the chance to maximize the benefits. For example, if you had a baby, you may qualify for credits or deductions you didn't before. But if you plan ahead, you can structure your finances to take full advantage of them. Planning ahead also means thinking about the following year. Too many people treat taxes as a one-year problem, but it's really a long-term game. Decisions you make in 2025 will affect not only this year's return, but also your financial situation in 2026 and beyond. For example, contributing to a Roth IRA today doesn't give you a tax break now, but it sets you up for tax-free withdrawals later. Charitable contributions or business investments might save you money today while strengthening your position for the future. And here's one more crucial piece. Get professional help early. Waiting until the deadline to find a tax advisor or accountant is like calling a mechanic the day your car breaks down on the highway. They're overbooked, stressed, and won't give you the attention you need. But if you build a relationship with a professional ahead of time, 8, they can guide you through the year, give you strategies specific to your situation, and make sure you're always one step ahead. Let me give you a simple example. Imagine two friends, Lisa and Tom. Lisa ignores taxes all year, then shows up in March with a box of receipts. She finds out she owes 3 doubles null osen, and there's nothing she can do about it. Tom, on the other hand, checks in every quarter. When his income rose mid-year, he increased his 401k contributions. When his investments did well, he harvested a few losses to balance it out. By December, he already knew what his tax bill would be, and it was far lower than Lisa's. The difference: Tom planned ahead, Lisa reacted too late. The bottom line is this: you can't change what's already happened, but you can shape what's about to happen. Planning ahead puts you in control. Reacting at the deadline leaves you at the mercy of the system. With the 2025 tax changes, 8, those who think ahead will keep more money in their pockets, while those who don't will pay more than they should. So don't just focus on April. Treat taxes like a year-round process. Make adjustments, check in, and get help before the clock runs out. Because when the deadline comes, 8, the game is already over. And the question is, will you be the one who prepared or the one who paid the price?